Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today we're going to be talking about strategies in commercial and why there definitely isn't one size fits all in deciding on which strategies you want to go for in commercial. So possibly one of the most irritating things that can be said is if you're saying, right, tell me what to do in terms of what I need to invest in, tell me kind of what's the right strategy for me. And, you know, I do help my clients with that. I work with hundreds of commercial property investors. I invest myself. I know exactly what is working. But the fact is that whenever someone asks me that question, there's a lot of follow-on questions that I need to ask to understand their motivation for investing and also where they want to get to. Because at the end of the day, all of that means that it depends. It depends what they want to get out of their investing as to what strategy is right for them. So very often my answer to that question is, it depends. And then obviously there's a number of follow-up questions. So I thought today I'd do the podcast with you where I kind of talk to you about all the different routes you can go down with your commercial investing. And, you know, you can start having a think about, if you're in this position, you can start having a think about what might be right for you. And obviously with my board clients, I do this very intensely, and you know, sometimes it takes a while to do, but once you've nailed it, and you could just go out and find those deals. So the very first thing we need to look at when I get asked that question is, why are you investing? And that might sound ridiculous because I want to get some income in, I want to make some money. But there's different types of income that you can go for. There's different types of money that you can hope to achieve in commercial. So this is the wealth hierarchy. And, you know, if you've seen me do any talks, you'll see that I present like a triangle. This is not my model, but it's something that I find very useful when I work with clients. So at the bottom is cash flow. And cash flow is really, really important, obviously, if you haven't got your monthly costs covered, because whether that's a cost for business or whether that's personal costs, because there's no point getting lumps of cash coming in if you haven't got your cash flow covered. And one of the biggest mistakes I see property investors make is going straight from maybe a job or, you know, having no cash flow coming in to development or to profit strategies, which is the next level up, because basically in that level you're in feast or famine. You either have a load of cash coming in or the cupboard is bare.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
And that's the nature of development. That's the nature of these profit strategies, is that it's fantastic when the money comes in, but it can be difficult when it doesn't, especially if you've got overheads, you know, family overheads or business overheads. And so cash flow strategies, you know, get your monthly costs covered, then obviously you can move up to profit strategies. And then obviously at the top of the triangle are the equity strategies. That's equivalent to a pension. So if you look at each level of the triangle, then cash flow is equivalent to your monthly salary if you're in a job. Profit is equating to bonuses, and equity is basically relating to your pension. You're creating equity for the future. And everybody's at different stages. And as I say, one of the biggest mistakes that you can make is going straight into the profit strategy. And, I've seen a lot of investors really struggle because, when deals come off, when profit comes in, then that's a great thing. But then you obviously need to then reinvest that into land or into development projects, which aren't giving you cash flow ultimately. And when I first start working with a lot of SME commercial property investors, or people who want to get into commercial investment, then they've heard a lot about commercial to residential. If you're a residential investor already, that can feel within your comfort zone because you understand it, you understand residential, and it can be a great strategy. What I'm finding actually at the moment is that a lot of purchase prices for that kind of product are very expensive. Especially in the southeast and the south, because vendors and agents are basically pricing in permitted development rights, which are now, very, very commonly known. I remember back in 2011 when we were doing office to resi, and there was loads of opportunities because you could pick up properties at really cheap prices, secondary offices that you could then refurbish. But now permitted development is really well known, and it's just being priced into deals. And so, and also obviously the GDV, the end value of the residential, is really important. And there's lots of areas of the country where that doesn't work. And thirdly, build costs are really expensive. We all know what's happened to build costs. I won't go into detail on that. We know what's happened to energy costs, material costs, and wage costs, and inflation has gone up. So that means that it can very often make projects unviable, unfeasible. And this is why I always advocate multiple exits in commercial, because you want to have a commercial exit or exits ideally, and then an ultimate maybe commercial to resi exit. But you don't need to do that exit very often. When I look at client deals and they're bringing these kind of deals to me, very often the commercial exits are a lot simpler, but B, can give you that nice cash flow strategy you're looking for. The resi exits is a profit strategy, ultimately potentially also giving you cash flow, but you've got a time lag and viability can be challenged. So don't run before you can walk. Don't skip the gears. If you need to have cash flow strategies, then stay at the cash flow stage, move up to the profit strategy, and then move up to the equity strategies on top of that. Obviously, you can create equity through profit strategies and cash flow strategies as well. So first thing that we need to ascertain really is, are you looking for cash flow, profit, or equity? And commercial deals vary. So if you've got cash in the bank from a business, profits from a business, if you're a lot of the big high net worth investors are like this. They just want to park their cash in commercial into great assets with great tenants on long leases, because they're going to get a return, and they're not interested in necessarily adding value. What they're interested in is their cash on cash return, effectively. So this is where properties like long leases on food stores, so say you've got a Tesco covenant or a Sainsbury's or Asda's or whoever, then you potentially get a 15-year lease with RPI or CPI linked upward only rent reviews. If you buy one of those assets, even if there's a couple of years that have expired, you're basically, there's nowhere to go really with regard to asset management, but you are buying an asset where there should be great longevity, because you've got a long lease, you've got a great tenant covenant who's not going anywhere, and you've also got index linked rent reviews, which means that if you want to get a return, you probably can get somewhere between, depending on which part of the country that is, a 5.5% to 7.5% return on that type of money, maybe slightly higher, and that's beating the banks, that's beating bond yields, and you're kind of happy with that. But if you're at the stage of creating wealth, where you actually want to create those lumps of cash, where you want to get your money out of deals, then I wouldn't suggest that you invest in assets where you're just parking your cash. You want to find assets where there's something to do, whether that's a physical works that you can do to improve the property value, or whether there's paper-based asset management strategies that you can do, which are really common in commercial property, where you can add value. And obviously, ultimately, you could do development, but you don't necessarily have to. And so this is why, sometimes when I work with clients who've sold businesses, or have got profits and are time poor, they don't want to spend their time doing asset management. They just want to park their cash into assets that are going to generate them a good yield, and that's fine. So I think this is why it depends. Kind of why you're investing, what your circumstances are. And then the third thing we need to look at is risk profile, because obviously not everybody has the same risk profile. If you're buying a vacant property, there is inherently an amount of risk that's associated with that, because you've got no income coming in, you've got no lease, you've got no tenant. Now, if you understand commercial, and if you understand that particular market, if you've got great relationships with commercial agents, if you understand the supply and demand in that market, which ultimately is what drives commercial property. So you're understanding what tenants would take that property, what kind of rent they would pay, what kind of lease terms they would take it on, then that risk can be massively reduced. But on the face of it, buying a vacant property in an area where there's lots of other vacant properties is relatively high risk. So, the type of property that you're going to buy, the strategy that you pursue is definitely determined by your level of risk. Do you want an operational business? Are you happy to run a serviced office business, for example? There's an element of risk with that, because you're running that business. It's not hands-off income like a lot of commercial strategies are. And then, just certain types of property, if you're doing new build, obviously there's an element of risk with that. Now, all of these risks you can mitigate. So what I'm not saying is that, don't do any of these strategies. All of these risks can be mitigated. So, for example, let's take the vacant property risk. So if there's 100, say it's a retail unit and there's 100 vacant units around it, then I would say that's a pretty large risk, because supply and demand obviously is very much in the favour of supply. What you're going to get is tenants who are playing each landlord off against each other, if you get any tenants interested at all. But if you've got a really well-performing high street that's pretty small, good socioeconomics, maybe some regeneration going on, and maybe there's one or two voids in there that because you know that market, because you've got great relationships in that market, that there's tenants out there that would take it. That's an opportunity. That's not a risk. So how do you differentiate between the two? Because ultimately, one person's risk is another person's opportunity. And of course, how to bridge that gap is knowledge. And this is why and you'll find this in a previous episode of the Commercial Property Podcast, this is why I talk about niching. And this is why niching is so powerful, because if you're an expert in that particular market, if you've got great relationship with commercial agents, maybe you've bought in that market already, you understand supply and demand, you understand what rents you could get, what rent frees you're going to need to give, what lease terms you're going to need to get achieved on that property, and the quality of the tenant. You know how long it might be vacant for, because you totally understand that market, then really you're mitigating a lot of that risk. You're actually not exploiting, that's the wrong word, but you're taking advantage of the fact that other people who might be investing in that market don't have the same level of understanding as you. So that actually, it doesn't become a risk at all, that becomes an opportunity. So knowledge can definitely bridge that gap. And that is why when I work with my board clients, and all my clients actually, there's an element of knowledge that I give them. But then obviously we look at how you apply that knowledge into deals and implementation. So it's really important to have some knowledge of strategies and of particular markets, so that you can actually have more information than other investors do. And once you really get established in a market, and you get great relationships with commercial agents, you'll be able to get off-market deals. You'll be able to very quickly which tenants will take space. You might even be able to approach tenants yourself, because you're a specialist in that particular market, and that's really, really important. So what we're talking about here then is risk profile is really important. So another factor, and then obviously we've got other factors like time, and whether if you've got a day job and you're investing, then do you have time to do active asset management? Now, this is where paper-based asset management really comes in. So you may not have time to do a development project, but you may have time to appoint an agent to do some lease renewals for you, or appoint an agent to let a vacant property for you. And there's a big difference between, being hands off on project managing development to kind of managing a commercial agent who's doing the work for you. So again, there's a mitigant on this. You might say, I haven't got time to do this, but actually, by investing in commercial, you're actually giving yourself time back, because you can, whilst there's some work to put in up front, you're getting hands-off income, longer leases, and obviously that can definitely give you your time back, especially if you can replace your income from your day job. So everything I look at with clients and everything I look at with my own investing for that matter is highly, highly strategic. What we need to do is we need to look at your motivation and some of the obstacles you're up against, and then how we can mitigate those. And, having worked with hundreds and hundreds of clients now, what I can tell you is that niching your strategies can massively mitigate a lot of the risk, as long as obviously you're niching in the right location. And the knowledge that you've got by not going in doing a big development, but potentially doing some, a lease renewal, or implementing backdated rent reviews, or letting a vacant property, or reconfiguring space so that you're going to get substantially higher rents. Playing the commercial finance game, which a lot of people don't know how to play, and listen back to previous episodes of the podcast to listen to that. As to how to do that. And also, I interviewed Callum Brooks, a great commercial property broker, and definitely listen back to that one. So this is why it depends. This is why it depends on your motivation, your level of knowledge, and your risk profile. And then once we've kind of decided on a strategy, and I'll talk you through some strategies in a minute. Once we decide on a strategy, then obviously there's smart ways of managing this. There's people that can help you. There's leverage you can bring in, like commercial agents, people like myself who can give you the knowledge, because I definitely wouldn't recommend investing in commercial without the knowledge. When I tend to work with people who've maybe got some commercial and haven't really know what they're doing, by the way, they would be the first to admit that. That's not me being derogative about them at all. But they're kind of like, I didn't really know what I was doing. I kind of bought it. They've actually more often than not left money on the table because they haven't had the knowledge to implement. So you kind of need that knowledge to kind of bridge the gap for sure. So what works well? So if you're after cash flow strategies, what I always look at is finding a niche where demand is higher than supply. So whether that's in retail, industrial, offices, whatever it might be, hotels, if that floats your boat, then finding those locations where there's better demand than supply. Now, it might be that for the unit that you've got, there is no or very little demand, and therefore the rents are low. You're going to have to you'll get short leases. But if you can reconfigure the space, then actually there might be loads of demand. And I do this strategy, and lots of clients of mine do this strategy in industrial, because very often for larger industrial space, there isn't much tenant demand in lots of locations. But actually for much smaller space, there is. And not only that, but those tenants will pay sometimes almost double the amount of rent you'd get for the single let larger space, because there's a lot of tenant demand. And compounded on top of that, the space lets really quickly, and tenants want to stay for longer. So, you can actually create space that tenants are looking for. And, again, if you've got a knowledge of that market and you understand it, clients of mine who understand their niche and understand that market are absolutely cleaning up. They're finding deal after deal after deal that just work for them. And, so it's worth kind of pausing and kind of working out what you want to do. Other things that are working well at the moment for cash flow are mixed use. So commercial with uppers, where you can do some form of title splits. Now that's a buying price strategy. So if you can buy the uppers for the same price that the uppers are worth, So if you can buy the whole property rather for the same price that the uppers are worth, then you almost kind of get the commercial thrown in for free. And finance, buy-to-let finance and commercial finance is most definitely your friend with regard to that strategy as well. So they're working really, really well at the moment, and you're kind of pushing it an open door for both strategies. Multi-let strategies, commercial finance really likes, and mixed-use commercial finance really likes. So they're two strategies that are working really well. But just really simple, straightforward asset management strategies like buying a vacant property, doing a lease renewal on a lease, because valuers and banks don't like uncertainty. A client of mine recently bought a property where there was multiple industrial units. Basically, the whole place could have emptied out within a month because they were all holding over on rolling leases and licenses, and so the whole place was a bit of a mess. It hadn't been well managed. And she's methodically gone around and put everybody on longer leases, and she's getting a substantial valuation uplift as a result because the risk is lower. Because actually that property now can't be emptied out within a month. It can only be emptied out within 3 years. So valuers like it more, banks like it more, commercial finance likes it more, and the valuation is a lot higher, and she's increased the income in the meantime. So finding properties that haven't been well managed, or where that there's lease changes you can make, you can let vacant properties, you can reconfigure space. They're all opportunities that you can pursue. So it's just a matter of consistency in terms of trying to find those opportunities, building relationships with commercial agents. And just remember, I think the message I want to leave you with really is, don't assume that all strategies fit everybody. It might not fit in your particular location. Do you want to invest close to home or further away? If you want to invest close to home, then some of the particular strategies I've just talked about might not actually work in your investing location. So how could you get that? How could you invest more remotely? Who could you get to help you? Or B, what strategies are working locally? Or do you just need to pick an alternative location? And not all strategies will suit everybody. If you're at the stage where you just want to park cash, then finding nice long leases to great tenants will work. If you want to add value, then what we're looking for is multiple exits. And ideally kind of going down the line of lease resistance, keeping property as commercial, renewing leases, extending leases, letting vacant properties, and basically doing what we can to improve the valuation. So next time, so you ask somebody about a commercial property a strategy, or my clients ask me about it, and I say it depends. I'm not kind of ducking the question. Far from it, actually. You need to kind of be asking yourself these questions in terms of, what's my risk profile? What time do I have? What do I want to invest close to home? Do I want to invest further away? Which stage am I at in terms of cash flow, profit, equity, etc.? And then you will get a lot more clarity in terms of what you're looking for. So thank you so much for joining me today, and I look forward to seeing you next time on the Commercial Property Podcast.